Hi, this is Dean Hoffman. I am the president and founder of Hoffman Asset Management Incorporated, and I want to thank you for taking the time to view this brief overview of our investment methodology. Hopefully you'll find it quite informative. Before we get too far along, I do want to stop and remind you that commodity trading does carry risks and is not suitable for all investors. You should familiarize yourself with all the applicable risk disclosure statements prior to making a decision to invest in managed futures. Let's start out by looking at the components that make up our investment strategy. First, there's portfolio selection, or the markets that we choose to trade. Second, there's entries and exits, which is how we decide to get into and out of the markets. And third, there's risk management, which is how we manage the risk during the entire process of the trade. Together, these three items work synergistically to create our trading strategy. Let's start out by looking at the entries and the exits. Hoffman Asset Management uses a combination of short-term, mid-term, and long-term trend-following systems in order to create a diversified approach to trading trends in the commodity futures markets. These are quantitative models that don't attempt to sell tops or buy bottoms, but rather are attempting to ride the momentum of sustained price trends. The only problem, as we see it, with trend-following systems is that most markets don't trend most of the time. And it's for this reason that we've created what we call our dynamic portfolio selection. What dynamic portfolio selection does is algorithmically scans and ranks the entire universe of tradable commodity markets on a daily basis. And then it's only those markets in the upper percentile of trending potential that make it onto our radar as possible candidates to trade. At this point, our various trend-following systems will scan this selection of markets to generate specific buy and sell signals. The idea is to only be in those markets with the highest potential opportunity, and also not to arbitrarily rule out any market because we began with a limited or a static portfolio. The final piece of the puzzle is with our money management, where we look to manage the risk on multiple levels. Specifically, on a per-trade basis, we look to risk no more than approximately 1.5% of equity per trade. In other words, for every $100,000 invested, we look not to risk more than $1,500. On a sector basis, we look to risk no more than approximately 5% of the equity in a given sector, meaning that should we already be in, let's say, heating oil and crude oil at the same time, and that adds up to approximately 5% risk, and we received the signal to get into a correlated position in unleaded gasoline, we would simply reject that trade due to the fact that we've already exceeded or are at our 5% per sector risk level. And finally, we look to risk no more than approximately 10% of our total equity at any given time, meaning that should every single position we are in simultaneously be stopped out at once, we would not want that to exceed about 10% of our total equity. This number is commonly referred to as portfolio heat, and in our case, we keep it relatively low. It should be noted that percentage risk levels are an approximation, and exact percentage risk levels cannot be guaranteed. In conclusion, we feel that by having a diversified approach with multiple trend-following systems, dynamic portfolio selection, and disciplined money management, that we are prepared to meet your expectations. I realize this overview is a high-level one and that you may have some additional specific questions. If so, please feel free to contact me personally. Once again, I want to thank you for your time and wish you a profitable day.